Of course, one of the big issues all week have been currencies, a source of dramatic stock volatility this week, with China beginning the week by allowing the yuan-dollar exchange rate to drift before the important 7 line. The president urging the Fed almost daily now to lower rates in order to weaken the dollar. We've been reporting on his tweets all week. Senior economics reporter Steve Liesman joins us now with a lesson in how to weaken your currency.
Game you can play at home if you live in the White House. Markets beginning to game out whether and how the U.S. government will take any formal action to weaken the dollar. I need to state, other than the president's tweets, I know of no formal or imminent effort to weaken the dollar at this time. But here's how you do it. You'd start off with open mouth operations. The president's sort of doing that, saying he would like a weaker dollar, telling the Fed to lower rates to weaken the dollar. You would move on, perhaps, to lower relative interest rates. If you wanted to be really fancy, you would go to lower relative real interest rates. That is, you would include inflation. We'll look at that more in a second. And then you would actually intervene in foreign exchange markets if that's what you wanted to do. The president has talked openly about Fed interest rates and weakening the dollar, likely more than the past 3, maybe 4, maybe 5 presidents combined. This has had little to no effect on the dollar's broad exchange rate, unless you argue it would be even stronger if the president didn't openly advocate weakening the greenback. Rate differences between Europe and the U.S., well, they look to have been more important, but not decisive. The dollar strengthened against the euro while the Fed was raising rates, and the ECB held steady at 0. Began to weaken well ahead, though, of the Fed's shift to hold, and then it's easing. This shows rate differences, a pretty uncertain tool. And if the move isn't coordinated, other central banks, well, they can just cut their rates to maintain the gap. That leaves actual intervention, where the U.S. sells dollars and buys yuan or euro in these cases. Typically, that's been done, it's only worked as part of a coordinated effort with other countries. And Mark Chandler, who helped me out gaming all of these ideas through in the last day or so, points out that the U.S. would end up, check this out, you'd buy European bonds with a negative interest rates. That is, you would essentially pay the Germans to hold U.S. savings. Not good politically. Or you'd buy Chinese bonds. What you do? Well, you'd help to fund the Chinese Belt and Road Initiative, which is what all this is about. So currency intervention, a tricky game. It's not a game you should play at home, maybe not even if your home is the White House.
I just like the open mouth operations.
Jawboning.
The jawboning.
Which doesn't seem...
I like the phrase really, open mouth operations.
You remember Robert Rubin, strong dollar, Jon Snow, Paul O'Neill, Tim Geithner, Larry Summers, strong dollar, and the president just tweets stuff out and the market kind of ignores it, I guess. It's a little unclear how the market's reacting to it. I guess you could argue it would be stronger if the president wasn't openly talking about it. But the thing is, I don't hear from currency traders or other folks that they think the United States is going to go in and do an actual intervention. We have a small amount of money in an exchange stabilization fund. Typically, the Fed comes in and matches that amount. You're shaking your head. Not going to happen. Not going to happen. It would not be effective unless there was. What you have to do is you have to have a definitive other side, no side to the trade to the traders. You have to say, look, we are weakening this currency. If you bet against me, you will lose. And that's why you bring all the other central banks in to this operation, because you have to breathe the fear of God into the traders. They can't feel like there's a winning trade here against the government.